Hello and welcome to myfinancesteacher.org. Today I'm going to share with you a hidden gem of a gold and silver developer. Generally, I would try to save some of the best information that I can find for the members at myfinancesteacher.org. In this case, I'll make an exception. We had a look at this hidden gem back a couple of years ago, so let's have another brief look together with much more details on the developments over the last couple of years, presented exclusively for the members at myfinancesteacher.org. So let's get into it. It's a developer. I don't usually look at gold and silver developers. We generally look at some of the larger, well-known miners. In this case, we're going to look at Artemis Gold. That's a developer in Canada with potentially a huge upside versus the ongoing market price. Remember, there are always risks. Development projects might not work out for a range of reasons, due to some management mistakes, or possibly due to failure to obtain required permits, due to high costs and high dilution that might destroy the returns to the shareholders. So given these understandable risks, the upside is very attractive. As usual, we're going to look at the discounted per share value after costs, all-in sustaining costs, long-term debts and taxes. And in this case, as it is a developer, I'm going to add the capex, the capital expenditures required over the first 5 years of the mine life as part of the long-term debt. As for the valuation factors, they're understandably gold and silver prices, the amount of reserves and resources in the ground, debts, capex required for this development, taxes. For taxes, I'm going to assume 20% for simplicity. We're going to look at the value per share, of course, taking into account the time value of money and the percentage of outstanding shares in insider hands. This is important, especially for a developer, in order to align the incentives for the managers and for you as a potential shareholder. Let me remind you that this is not an investment advice, and I'm not your licensed financial advisor. Now let's jump in to look at more details of each of these valuation factors. Starting with the gold price, we're going to look at 3 scenarios. Conservative scenario with a gold price of around $1,600 over the next few years. Balanced scenario with a gold price of $1,900 over the next few years. And optimistic scenario with a gold price of $2,200 over the next few years. To be honest, even our optimistic scenario is not too far out there. In a truly optimistic scenario, gold price might actually shoot up well beyond $2,200, perhaps much closer to $3,000 in a meaningfully inflationary environment. Additionally, in our conservative and balanced scenarios, we only take into account proven and probable reserves of gold and silver in the ground, without taking into account any of the measured and indicated, never mind inferred resources. And in the optimistic scenario, we only include half of the measured and indicated resources into the valuation, without including the other half and any of the inferred resources. So all of our scenarios, even the optimistic one, tend to lean more towards being relatively conservative. Next, moving on to reserves and resources in the ground, as well as the all-in sustaining costs. Artemis Gold has 8 million ounces of proven and probable reserves of gold in the ground and more than 62 million ounces of proven and probable reserves of silver in the ground. In addition to that, they have around 3.7 million ounces of measured and indicated resources of gold and over 60 million ounces of exclusive measured and indicated resources of silver. Beyond that, the developer also has inferred resources of gold and silver, but we don't even include any of that in the model. All-in sustaining costs are rising through the mine life, starting with around $578 or so. We're going to plug in the all-in sustaining costs of $580. And according to the most recent reports, the accuracy of these costs have improved somewhat. But of course, there is still some uncertainty to these all-in sustaining costs going into the future. Next, moving on to long-term debts. At the moment, the company has under $700,000 in long-term debts. However, looking at capex requirements for the first phase of the mine life, that's first 5 years of the mine life, that will require around $400 million in capex. I'm going to add that to the long-term debts, reducing the possible valuation of the company, bringing this long-term debt value to $491 million. For taxes, as I mentioned, we simply assume 20% tax. Artemis Gold has over 193.2 million shares outstanding. And just as I mentioned, let me remind you, there are risks, such as, for example, dilution risks. More on dilution risks and liquidity in the details for myfinancesteacher.org. Looking at insiders, the company presentations show that 41% of shares are held by the insiders. But looking at Yahoo Finance, we see that less than 28% is held by insiders. Just to stay a little bit conservative here, again, to suppress the valuation, to avoid being too excited about this fascinating potential, I'm going to plug in a lower value of 27.65% in insider hands. And we are going to discount the reserves of the ground over the mine life, which is 28 years if you look at proven and probable reserves only, or 35 years if you add half of the measured and indicated resources. And that's at the annual production rate at the beginning of the mine life. Again, at a later stage, production is expected to increase, in turn reducing the effect of discounting and improving the valuation. And for discount rate, we're going to use a relatively modest 5% in this case. Perhaps for a developer as opposed to an established miner, you might actually want to use a slightly higher discount rate. Let me know what you think about the discount rate down in the comments below. And beyond all of this existing potential, it's also worth pointing out that there is still substantial potential for additional exploration results over the next few years. But again, with a costly exploration procedure, so we might want to have a look at more details, which we will with the members at myfinancesteacher.org. So with all of these details in mind, plugging all of that into our valuation models, finally, let's jump into conservative and balanced scenarios where we look at proven and probable reserves only without adding any of the resources, neither M&I nor inferred resources. And in the conservative scenario, we'll plug in the gold price of only $1,600. Even then, if the development project works as planned, the discounted per share value of the gold and silver in the ground after costs, debts, and taxes gives us a fundamental share price of above $19. Again, there are risks, of course, that's without considering any future dilution. In the balanced scenario, we plug in the gold price of $1,900 going into the next few years. In that case, our discounted per share value after costs, debts, and taxes is over $23, which compares very, very well with the current price of under $3.50 right now. And lastly, looking at our optimistic scenario, where we plug in the gold price of only $2,200. It's not outlandishly optimistic going into the next few years. And in this scenario, we look at proven and probable as well as only half of measured and indicated resources, never mind any of the inferred resources or any future exploration potential. In that case, the discounted value of the resources in the ground per share after costs, debts, and taxes is over $31. So it does look very interesting over here, potentially a 10-bagger. Let me know what you think about that. But of course, as I've mentioned already, there are risks. Don't take this as a financial advice. Although the management has been working on de-risking the project. One of the examples of such de-risking is obtaining substantial financing from wheat and silver. Again, for more details, feel free to join us at myfinancesteacher.org. Have a nice day. Bye-bye.